All right, these PowerPoint slides are chapter 21 and 23 should be helpful, pointing you in the right direction for the quiz. Won't cover every single question for the quiz, but I think it helps kind of focus in on some of the main concepts that you'll see on the quiz. Chapter 21 is about incremental analysis. So as you remember, financial statements are supposed to help you make informed decisions, as in management or as an investor. And so there's different decisions you have to make. Sometimes you're thinking longer term decisions, but then what we're getting into here in this chapter is like these short run business decisions. And you look at it a little differently than just you would for a long-term investment. For example, short-run decisions, they're made with a fixed set of resources and must meet demands of current marketplace. No time to create demand or acquire a significantly different resource base. Costs identified as important for a particular business decision are called relevant cost. So I think there's a couple examples coming up, but relevant, it's all costs that are relevant for your particular decision you're trying to make. Most commonly is, okay, I want to invest in capital, like inventory or a piece of equipment or another type asset. And so what relevant costs do you need to consider when buying into that investment or buying that asset? And that's what we're talking about with relevant costs. Specific decisions, so good judgment about relevant information occurs by looking through more of a microscope on particular decision under consideration. Here's 4 examples of like these more specified decisions that businesses have to make. 1 is special order decisions, 2 product mix decisions, 3 make or buy decisions, and 4 joint product decisions. Here is a visual on what we are talking about with relevant financial information. So if you see up here at the top, you have financial information. So you have this information from financial statements that you prepared, from the income statement, balance sheet, and examples, your revenue, your costs, assets, liability. And you're bringing in data from historical financial statements, from maybe 5 years past, or from the last 5 years, your current financial situation, and then future oriented. You might hear words like pro forma financials. That's projecting into the future, an outlook of what you think your income statement might look like. And so you put that all into the decision-making tank, and then you go at it. And so then you're looking at that data for a specific decision you got to make, and then sunk cost spit out. Those are costs that you're going to have no matter if you make this decision or not. You're always, utilities or these fixed costs that you're always going to have. It's not really relevant to that specific decision you're trying to make. But the relevant information are, as you see down here, you're looking for opportunity costs, incremental revenue, and incremental cost, and out-of-pocket cost. So let's do an example to hopefully illustrate the term relevant cost. Assume that Red Star Ketchup Company is closed for a labor strike. During the strike, Red Star is incurring costs of approximately $15,000 per week for utilities, interest, and salaries of non-striking employees. A major film company has offered to rent the ketchup factory for a week at a price of $10,000 to shoot several scenes of a new superhero action movie. If the factory is rented, Red Star's management estimates that its cleanup costs will amount to nearly $2,000. Solely on the basis of this information, would it be profitable to rent the ketchup factory to the film company? Any thoughts? Should they do this or not?
It'd still make 8,000.
Offset the cost of the employee.
Yeah.
Yep.
Yes.
Yep. 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 I think you guys are onto something. Yeah, if the factory is rented, profitability for the week may be measured below. Okay, so that's one way to look at it. Okay, like that's just preparing a regular income statement, right? Does it anticipate operating a loss 7,000 mean Red Star should refuse the film company's offer? As you guys are alluding to, no, they probably should take it.
Some costs.
Yep, because the 15,000 is the sunk cost. So in other words, they're going to have that cost no matter what. It's going to continue, no matter if they rented out the factory. And this bottom bullet point, these differences are referred to as incremental costs and revenue. So here's a cool little visualization. If they reject the offer, they're going to still be out the $15,000 of sunk costs for the weekly factory expenses. But if they accept it, that goes down to 7,000. And so the incremental analysis, the incremental revenue is 10,000. And the incremental cost is this 2,000. Because remember, when you see the word incremental, when you're analyzing incremental, it's what is relevant for that specific decision. And then the incremental net income is $8,000.
You should negotiate with the movie company and make them pay 15 and their own payment costs.
Yeah, exactly, right? Yeah, but they're probably happy to get this revenue no matter what. Yeah, yeah.
Right.
Yeah. All right, so opportunity cost, that's a relevant cost. An opportunity cost is the benefit that could have been obtained by pursuing an alternative course of action. Here's an example of it. Assume that you pass up a summer job that pays $4,000 instead of attend summer school. The $4,000 may be viewed as an opportunity cost for attending summer school. One other thing to note is opportunity costs aren't there. It's not recorded on the financial statement, so you're not going to really see that type of cost when you're just going through it like an income statement. It's when you're analyzing these case by case specific decisions that you'll think like this. Sunk cost versus out of pocket cost. So the sunk costs, they've already been incurred, or they're going to incur no matter, like nothing can change it in the future. Out of pocket, it describes a cost that has not yet been incurred and that may vary among possible courses of action. So the out-of-pocket cost, that is an incremental, that's relevant cost. Sunk cost, it's not relevant. Okay, joint product decisions. Eric, do you guys manufacture at your business? I can't remember. You have inventory, but do you manufacture?
We don't there, but we have raw materials that we ship out to our vendor. We have aluminum.
So you're supplying a raw material to.
Yeah. We actually have a vendor that's in-house.
I see.
Uses from us. So.
I can't remember. Does anyone else work for a company that manufactures? Okay. What do you guys manufacture again?
We manufacture pumps, sprayers.
Pumps, sprayers. Okay. So do you use the same facility to manufacture the pumps and sprayers, or you have separate facilities?
We have it's called Riverside, so it's another building, but we have an office building and a manufacturing building.
But in the manufacturing building, it's one building
Yeah.
that's doing two separate products. Is that correct?
Yeah, it's multiple different.
All sorts of products. That's what this concept of joint product is. You're using the same, well, sometimes the same equipment, like same building, to manufacture like multiple products, like in your case, sprayers and pumps and whatever else. Other examples might include oil refineries, lumber, steel mills, meat processing companies. So these products are resulting from a shared manufacturing process. That's joint products. Manufacturing costs that relate to these products as a group are called joint costs. So in your case, the sprayer and pumps, you might share the same utility. You share the same property taxes, interest if you have a note on the building. And so if you're trying to analyze, cost for all the different costs for how to manufacture the separate, products, you're going to have some type of way to allocate these different shared costs to each different product that you're manufacturing. Okay, so two business issues arise related to joint products: how to allocate joint costs among the various types of products, and whether some types of products should be processed further to create an even more valuable finished good. Okay. Chapter 23, Operational Budgeting. All right, so this slide here, operating cash flows, the lifeblood of survival. This was, I think, in the book, in this chapter, I think it was talking about example NTI, but it said that that second bullet point, NTI's cash was literally tied up in direct materials, work in process, and finished good inventory. And then it talked about cash remained tied up in accounts receivable. So I showed you the next slide, so hopefully I didn't give the answer away too much. So if someone has their cash tied up in inventory and accounts receivable, would you expect them to have a long or short operating cycle? If you remember what operating cycle is. A longer one. So I think in this case, for NTI, their operating cycle was 247 days from when inventory was sold or sitting, being either sitting or being, it was stuck in raw materials being processed, like work in process. And then 81 days of collecting cash. So the operating cycle, once again, is from when cash went out the door to manufacture a product. So the cash going out the door is, raw material, direct labor, all the manufacturing cost, and then selling, this, I don't know how long it took for them to market, to sell the product, and then also to receive their money. And so when they finally received the money, it took 247 days. Another way to put it is cash was tied up in inventory and receivables for 247 days before converting back into cash. Now, think about all the different things that company still had to pay for throughout the 247 days. So, part of your business plan and you have, that's why analyzing cash flow is so important. So you can, take care of those payroll needs, material purchases, debt service, and other overhead costs that require cash disbursements. And according to this cash flow statement, they reported $250,000 negative cash flow from operations. So that might be a case where you might not have picked up on that cash flow restraint if you're just looking at an income statement. I don't know what their income statement said, but if, like, on their annual income statement, since they collected the receivable in less than 365 days, they could be reporting some pretty good profit. But the cash flow to generate that, like, negative $250,000, from operations. Okay, benefits from budgeting. 4 main benefits: enhanced management responsibility, assignment of decision-making responsibility, coordination of activities, and performance evaluation. All right, so moving on to preparing. Have any of you been a part of preparing a budget, maybe even for your personal finance or maybe some other organization? You somewhat familiar with what the budget is supposed to do?
Say money.
What is that? Yeah.
What is that word?
Yeah.
Savings? Hello?
Cool. So yeah, one of the main assumptions on the budget is establishing these estimated amounts, or budgeted amounts. And there's different ways to look at that. Most of the time, you just compare. Over time, hopefully you know your spending habits, or you have some history that you can draw upon, and actual performance that you can use to help set a budget amount for a particular category. There's 2 basic philosophies that dictate the levels of which budget amounts should be set. One is the behavioral approach, and second is the total quality management approach. The behavioral approach, most common one that companies use. The behavioral approach assumption underlying the behavioral approach is that managers will be highly motivated if they view the budget as a fair basis for evaluating responsibility centers performance. So in other words, like not an like make it realistic. Make a budget that is challenging for a manager that's responsible for maybe a certain cost center, or maybe they use the term responsibility center. Because it brings a sense of accountability to that manager or even the people on that team to, meet budget or have a good reason why they're not meeting budget. Then secondly, budget amounts are set at reasonable and achievable levels. That's very key with the behavioral approach. If it's just always out of reach, then your manager would be like, they're just gonna, we don't have to perform. I mean, they're just gonna say, they'll always give us a free pass and unrealistic goals, and that's not what you want to do with the behavioral approach for sure. So a department that operates highly efficient manner should be able to exceed the budget level of performance. Second, failure to stay within budget is viewed as unacceptable level of performance. This was a slide on the budget period. It's the period that you're comparing the actual versus the budgeted amounts. Typically, you do an annual budget, and then companies typically review their performance at least quarterly. So the other philosophy was total quality management approach, and that is every individual segment of the organization should strive for improvement constantly. And the entire organization committed to the goal of completely eliminating inefficiencies and non-value activities. Basically, it's the organization strives to achieve perfection across the entire value chain. Rolling budgeting is that's a term that an increasing number of companies use. The rolling budgeting. New quarter, a month is added. So rolling, it is what it is. So basically, if you're viewing it on a quarterly basis, you're always adding the next quarter to the report each time that you're analyzing the report. Budget always covers the next upcoming 12 months. So you think about it, like we're just got done with about half the year. We're in August, so right now companies are closing books through the end of July. So that's what their accounting department is doing, and CFO is reviewing is financials through year-to-date July, and so more than likely they'll have if they're meeting monthly to talk about budgets, they'll have a budget meeting probably here at the end of August or middle of August, and they'll talk about how they did all the way through July, but then they're also looking forward and adding the upcoming 12 months, and so they're not just looking at what happened and comparing the budget through July 2019. They'll be looking through budgets through July 2020, or if they're using this rolling budgeting approach, right? So. last point, it forces managers to always just be continuously reviewing and always on top of things, you know, assessing their budget, doing it this way. Okay, a master budget. Typically for manufacturing companies, they have what's a master budget, and it's like all sorts of budgets that roll into one big budget. So it's like a budget for operating budget, so that you'll have your sales budget, production budget, cost of good manufacturer and sold budget. So all those budgets flow into one operating budget. Also, selling administrative expense budget, cash budget for capital expenditures, those roll into the operating budget. Then number two, you have financial budgets, income statement, balance sheet budget items, cash flow statement item budgets, capital expenditure budget. So yeah, that's it for these slides. I think now's a good time to take a break. We can take a 10-minute break and come back.